So your final exam, we have 3 questions, I told you, right? 3 questions. So the first part is multiple choice, around 35, 36, around 14 questions. So 14 questions, maybe 2.5 each. Okay. Then we have a 1 short answer question related to chapter 4 and chapter 14, short-term decision making. So whenever we do decision making, cost, benefit, opportunity cost, is there any additional positive or negative? Then we have another question, which is what I want to do today. I want to show you, okay? So we have chapter 13 and chapter 18 together. So chapter 13 is a long-term decision making. So how do I put the 2 together? What's my logic of putting the 2 together? So basically, decision making, short-term decision making, long-term decision making, if you make the right decision, a good decision, you're going to have a benefit. That linked to performance evaluation. But performance evaluation usually is 1 year at a time. Because you don't say, you perform very well, 3 years later I tell you the outcome. So I have to give you the performance evaluation every year. So whatever the measure is 1 year. Chapter 4 is also 1 year at a time, but chapter 13 is multiple year. So time value of money is important. Okay, so I'm going to pull out all the chapters we're going to do today. And I'll try to do as many questions as I can. Alright, so Jewel. Okay, so chapter 18. Okay, and then questions we're going to work on. Chapter 13. Okay, and then remember whatever I do today is going to be in your final exam. Okay? Chapter 18. Okay, so before we go to chapter 13, I want to ask you a favor. Course evaluation. You have to do it. So far, very low. Percentage, participation, very low. Look at this, only 18%. I don't know how many, I don't know. This is all I know, okay? So we're not going to do in class. I don't have time for you to do in class. I just want to finish the course. So please, when you have a chance, please do it. I want 75% like you, right? You want your mark 75%. I also want 75% participation rate. And if I don't see 75%, I keep bugging you. I keep sending you message. So you have up to next Monday to do it, because once the exam starts, you cannot do the course evaluation. So please, see ours very low. Try to do it, okay? All right. So let's go back here. Oh, another question I want to tell you, okay? You go to the final exam review question. Not the comprehensive review question, okay? Not these ones. Here, exam preparation material. You go to final exam review questions. Here, the first question. Final exam review review question, both are PDF, so it's right. PDF. This question, Ibrahim Asafi, this question, also important. Okay, so I'm going to start talking about chapter 13. So last class, we talked about payback period, we talked about accrual accounting rate of return, we talked about net present value, but I did not do the question yet. Okay, so I'm going to go over very quickly about net present value. This is the best method to evaluate investment decision because it's from the beginning to the end. When you do a question in the final exam, sometimes you get a conflicting message. You may say, payback period, go ahead. ARR, go ahead, do it. But net present value is negative. Okay? So you should reject if net present value is negative because whatever your cost is greater than your benefit, you shouldn't go ahead and do it. So net present value trump everything else, determining you should do it or not. Not payback period, because payback period, after the payback period time, what happened? You still have a benefit, but you don't count that. Okay? So I'm going to tell you about net present value. What happened with net present value? Net present value, we talk about, it's a long-term investment decision. Long-term. Okay? 3 components. Today, I have a cost. So number 1 is negative cost. Okay. Number 2 is the benefit. Okay, so number 2 is benefit. But the benefit is many, many years. The end of the project, maybe 10 or 15 years, the value is not the same as today's value. So we have to discount it back. The benefit, we need to discount it back. So this is positive. The first one is negative, the second one is positive. The third one is what I say opportunity cost. Positive, negative, we don't know. Is it additional benefit or no? So this is called terminal value. I call it terminal value because the end, your project is done. The end, terminal value. But this is only one time. You also have to discount it back. So as we did it in chapter 4, what's the cost? What's the benefit? What's the opportunity cost? The only difference between this chapter and chapter 4 is this chapter here, you have time value of money. So we need to present value of the benefits, annual benefits. Okay? Terminal value, we also present value of the terminal value. The second one is positive. The third one can be positive, can be negative. You add them all together, positive, go ahead. Now, what happened? The cost, there are 3 components inside. There are 3 items inside. Okay? Annual benefit, you have to see how much you're going to save. I call it benefit because in finance, you learn something called cash flow. In cost accounting, we call it cost savings. If you save money, you don't spend money, it's the same as cash coming in. So I just use the generic term called benefit. Okay? Now, opportunity cost is the end. We have 2 items. Okay, so very quickly, net present value. When we do the exam, this is what you do, okay? Number 1, you tell me what's the net initial investment. This is a negative, the cost. So the first component is the cost of investment. You want to buy a truck, delivery truck, how much it costs? $100,000? Okay, so that's negative. Now, number two, you add any trading value. I call it trading value. So basically, you have an existing asset, but you don't need the two assets together. Just like you want to buy a delivery truck. You go to the dealership, you say, I want to buy a delivery truck. How much does it cost? They say, 100,000. You say, fine, but I have an old one, I want to trade it in. How much are you going to give me for this old truck? They say $2,000. Okay, I get $2,000. I pay you 100,000, you give me 2,000. Trading value, reduce your cost. So this is $98,000, for example. Okay. Number three, this is the most difficult part. Can be positive, can be negative. This is called working capital. So when you invest, this is where students always make mistake. When they make mistake, this is the part they make mistake. I just tell you exactly how students make mistakes, so you pay attention to this, okay? So you add a positive working capital. This is when we say free up or release working capital. You learn from cash flow statement. More asset you have, you must use your money to buy asset. So you have working capital, current asset, current liability, for example. If I have more inventory, I must use money to pay for inventory. What other choice you have? You cannot have more inventory, more cash. It's not possible. I love shopping. And the more things I buy, the less money I have. They go opposite direction. So if I can free up, release inventory, I don't have to keep up so much inventory, money saved. If I need more inventory because I buy new machine, the new machine is going to allow me to sell more, make more, and sell more, I need more inventory. This is called tie up. Require more. When you require more working capital, meaning you need more cash. Okay? So can be positive, can be negative. This is where student made mistake. Once you determine wrong, everything else is wrong. Three components. Okay? I'm going to explain to you this in a minute. Now, number two, annual benefit. We have to present value back. Okay, you can save material, labor, overhead, whatever you can save. Okay, one thing important here is we only look at the cash flow. All these methods, only the accounting rate of return. We include depreciation. Everything else, no depreciation. Please do not include depreciation. Everything else, no depreciation. Only accrual accounting rate of return. Only that. So here I'm going to make a note. Do not include depreciation amortization because non-cash. Cash flow. Okay? Number three, present value of the terminal value. The end, one time. So there are two components. The first component is the incremental residual value. Incremental residual value. So what happened is, you have an old machine or old equipment. You're thinking to buy a new equipment. Okay? So you compare the new minus the old. So the old machine may give you 5,000 residual value. The end of the 10th year, you get $5,000 back. The new equipment also give you $5,000 back. So you take the new minus the old. New give you 5,000, the old give you 5,000. You're not better off, you're not worse off. There's no difference. There's no incremental. They're the same. By investing in a new machine, you're not better off, you're not worse off. Sometimes, if you buy the new machine will give you $5,000 residual value in 10 years. But the old machine only give you 1,000. By investing in the new machine, you get additional 4,000. Positive. Remember I told you the story about my sister's apartment? She invests 28,000 in order to get not 2,000. Without the investment, she only get $1,400. By invest 28,000, she get additional $600. So by investing in this machine, you get not 5,000 because you were already going to get 1,000 before. So by investing in a new machine, you get additional 4,000. Another situation is the opposite. That's why I said this part can be positive, can be negative. Nobody knows. You have to read the question. The new machine give you 5,000. But the old machine maybe give you 7,000. By investing in a new machine, originally, if you don't invest, you get 7,000. Now you invest in a new machine, you get less. So, $2,000. You lose out by investing in a new machine. You don't know. You have to look at the question. Okay? So how do you calculate? You always take the new minus the old. Number 2 is the reversal of working capital accounts. Reversal. So what's the reversal? Here, look. In the beginning is positive. The end, tie up. Reverse. In the beginning is negative. The end is release. Working capital. Okay? However, this is many, many years later, 10 years later. The face value is the same, but 10 years, 10,000, and the end of first year, 10,000. Oh, right now you pay 10,000, you say 10,000. It's different. The value is different. So we have to discount back. You add the two together, you have to discount back. You cannot cancel out. I think previously one professor said you can cancel out. You cannot because time value of money, different value. This is the end, 10th year. That one is right now. How can you cancel out? Okay. You add the three things together, positive, you go ahead. So what is this working capital? Okay, a student always make mistake. Let's say with the old machine, a lot of problem, jammed up, bottleneck. Okay, waste a lot of material. So the material inventory, I need to have $50,000 always, $50,000 in inventory, material inventory. Okay, so now I'm thinking to buy a new machine. The new machine will drop because more efficient, won't jam up, no bottleneck, I don't waste so much inventory. So the inventory can drop down to $20,000. I only need to keep 20,000. I don't need to keep 50,000. But this change only one time because year after that, 20,000. So this is to save inventory, 30,000. This is called release inventory. I don't need to keep 50,000 inventory. I only need to keep 20,000. So I can release, I can free up. Positive. But when I finish the project, go back to original. That's why it's reversal. Once you finish the project, 10 years, 5 years, reverse back, 50,000. So from 20,000 back up to 50,000, you tie up. Require more, 30,000 cash inventory. Okay, so this is how it works. Now reversal. Sometimes capital, for example. Okay? So when you have an old machine, not very swift, okay, so you don't sell so many. Now you change the new machine, you can sell many, many units. When you have so many units, you have lots of customers, you give them credit terms. You say, okay, you can pay me 30 days. So your accounts receivable go up. Accounts receivable go up means you did not receive money. So before, you only have 10,000 accounts receivable. After you switch to the new machine, accounts receivable go up, you do not receive money. Now, this is 60,000 accounts receivable, you do not receive. This is called tie up. 50,000 cash. The end, you go back down to 10,000. So you free up 50,000. So in the beginning negative, the end positive. In the beginning positive, the end negative. That's why. But the end positive or negative, it's not the same value as this beginning because time value of money. Okay, so very quickly, I'm going to summarize this and we're going to do question. So 3 components. The first component is the cost, net initial investment, the cost of investment given to you. Trading value should be given to you, positive. Working capital, make sure you know how to determine positive or negative. This is where students make mistake, always. 3 numbers, 3 marks. Cash flow, so no amortization, depreciation in here. No amortization, depreciation. You discount it back. What's the interest rate you're going to use? It's called required rate of return, RRR, required rate of return. Okay? You bring it back. Now terminal value, 2 numbers, incremental, residual value. Number 2, reversal of working capital. You add the 2 numbers together, you discount it back. Okay, so that's that. Now, IRR is the interest rate. IRR is the interest rate, make net present value equals 0. So basically, how I say it in a common sense way is interest rate, break-even interest rate. You plug in this interest rate will break even interest rate. Sometimes question will ask you, what's the cash saving, cost saving you need to achieve to break even? So then they ask you the other number. Okay, so let's quickly do question to show you. It's easier to show you. All right, so I'm going to do this FAB, the 2 FAB question. This question has all the components in there, but then I'm going to introduce more components because I will test you in the final exam, okay? Tube fab is considering replacing its metal tubing machine that purchased 2 years ago, okay? Costing $50,000. They paid 2 years ago, $50,000. This machine is still in good condition, but management wants a flexibility. They want lower manufacturing costs. So the actual current market value is $20,500. If you're going to get rid of it now, you only get $20,500. Only 2 years. The value already dropped less than half of it. Okay? So what happened with chapter 18 is performance evaluation. When we evaluate manager's performance, if you use the accounting income, the first year you're going to lose money. You don't want that. You won't want to invest. If you're going to be evaluated based company's net income, you won't do it because right there is a loss. Okay? So now the salvage value is $2,000 in 10 years. From now on, there's another 10 years. So the whole machine should be able to use for 12 years. Okay? Now, a manufacturer, you have to be able to read the question yourself because I cannot explain the question to you in the final exam. Okay. A manufacturer is offering a new metal tubing machine at a price of $60,000. Want to sell to you $60,000, and this is better machine. Okay. This machine also can last for 10 years. So you purchased the machine before, 2 years before. Now 10 years to go. The new machine also 10 years to go. So it's good because we can compare the same numbers. Now after 10 years, we get 4,000 residual value. Okay, so now you think about this. New machine give you $4,000 if you invest in it. The old machine give you $2,000. So by investing in a new machine, you get additional $2,000 in 10 years. If you don't invest, you don't get this additional $2,000. Okay, so this is that. The machine will require additional $5,000 in working capital. Okay, listen. You need more working capital. What does it mean? Need more working capital. Need more money. You have to pay money for inventory. Money going out. Require more. So you have to be able to interpret it's a positive or negative. That's why you require more money for working capital. Negative. Okay? But you will recover it, reverse. You can get it back in 10 years. But 10 years, 5,000 is much less than 5,000 in today. Okay, so now you're going to see the difference, the old machine and the new machine. Direct labor, the old machine spend more, new machine 79, you save some money there. Machine cost 3,034. Okay, so here machine actually costs more to operate. Now cleaning up, cleaning setup, okay, we have a savings. Amortization, 4,500. Don't be fooled. If we're doing the net present value, do not include this part, okay? So I'm going to show you how we calculate 4,000 versus 5,600. Okay, so the old machine, $50,000 the cost, minus the 2,000 residual value. Divided by 12 years. You know why 12 years? 10 more years to go, you only use the machine 2 years. Altogether, 12 years. 48,000 divided by 12, 4,000 a year. That's how we figure out 4,000 amortization. Okay? The new machine, 60,000, the end, 4,000, so 56,000. How many years? 10 years. So 5,600. So the new machine actually amortization more. You subtract more. Okay. Accounting income. Okay? Calculating accounting income. Gain or loss from the sales of the machine. Okay, so machine costs 50,000. We use 2 years. Each year, 4,000 amortization expense. So we accumulate 2 years, 8,000. The carrying value, this is called carrying value. How much in your book? 42,000. If you sell it now, get rid of it now, 20,500. Okay, so you're going to lose 21,500. This is the loss. 21,500. So this leads to the next chapter that we're going to talk about it in half an hour, okay? If you're going to be evaluated based on the accounting income, you are not going to invest because you have negative, nothing to show for. Okay, so now what do we have to do? We have to do a minimum desired rate of return 8%. The cutoff period is 4 years, so payback period 4 years. What is the net present value? Calculate point of indifference in terms of annual cost savings, benefit. So this is a break-even benefit. Payback period, accrual accounting rate of return, based on your calculation, are you going to invest? You're not going to invest. Okay, so I need the time value of money table. I will give you this table. Don't worry about it. View. Here also. Okay. So back to the question. Okay, so the first one is net present value, NPV. Number one is a net initial investment. By the way, did you submit your 10-page oral presentation? Did you do it? Because every year the last group always gets shortchanged. They never have enough time to finish because changing group take too long. And that's why I ask you to send it to me, so Thursday when you come to class, right away I upload it all here. Your group come up, just click on it, you can start presenting. And also the other thing is, I want you to stay till the very end, okay? In my class, you leave early, I don't take it personally, okay? I don't feel offended or anything. But if your friends, your colleagues, your peers stay for your presentation, you should stay for their presentation. I just find it's bad that you leave early. Once you're done, I have to go. It's not okay. Last semester, I was very annoyed. And I told them, I still have student. Just got up and left once they finished presentation. If you do that, okay, I'm going to deduct marks from your oral presentation. It's just not polite, okay? For me, it doesn't matter. But for other students, it matters. It matters to me, okay? All right, so net initial investment. If you haven't uploaded, let me know, because I already closed yesterday. Today, so you can still upload it. Okay, net initial investment is the cost plus trade-in plus minus working capital. Okay, cost is 60,000. If you trade it in now, you're going to get positive, which is 20,500. Okay? Working capital, what did I tell you about working capital? You need more. You need more money tied up. Okay? So you need 5,000. Alright, so you need more money spent on this. Okay. So altogether, the net initial investment is 44,500. Okay? 1, 2, 3, 3 marks. 97 marks to go. Okay, number 2, present value of annual benefits. Please do not include amortization. Okay, so I take the difference. Usually I take the new minus the old. But all these are expense, money you pay. So you take the new bracket minus the old bracket becomes positive. So I just easier. I just use the new minus the old. Okay. So I'm sorry, old minus the new. Okay, so old minus the new because both are expenses. Okay, direct labor, 13,500 minus 7,900. So I save 5,600. Okay, machine 400 for expense. Cleaning and set up. 2,500 minus 1,200, so I save 1,300. Please do not include amortization. If you include amortization, everything wrong. Okay? So now if you add together total annual, you can call it cash flow, cost savings, benefit, whatever you want to call it. Alright, so we save 6,500. This is a benefit. How many years? 10 years to go. Times present value interest factor, annuity. What's the required rate of return? 8%. 10 years. Okay, so now I go to this table, annuity. Not because 10 years you times 10. No, time value money. So annuity, I go to year 10. Make it bigger so you can see better. Okay, I keep going. 8%. Okay, so this is the number. 6.7101. So you times that. So 10 times, you don't times 10. You only times 6.7101. This is time value of money. You get less. So 43,616. The cost, the benefit, still not enough. We have to look at the terminal value, number 3. Number 3 can be positive, can be negative. We don't know. So present value of the terminal value. I call it terminal value. 2 numbers. A, incremental residual value. Because it's a positive, I take the new minus the old. So the new machine is going to give me 4,000. Old machine only give me 2,000. So by invest in the new machine, if I keep it for 10 years, I get additional 2,000. B, reversal of working capital accounts. Okay, working capital accounts in the beginning is negative. So the end should be positive. Beginning negative, the end reverse, positive. So what happened is the residual value is 7,000. But 7,000 is in 10 years. How much is it worth today? Only one lump sum, not annuity, not every year you get 7,000. Only one time, the end. So I have to go back here. Okay, so one lump sum, make it bigger for you to see. So I go to 10 periods. Okay, go to 8%. So interest factor is 0.4632. So this is a positive number, is 3242. This is net present value. Chapter 4, we said net benefit cost of doing something. So this is net benefit of cost, taking the investment decision, buying this machine, so net present value. You add the 3 things together, okay, you add the 3 things together, this is 2358. If you need to take a picture, take a picture, okay? Okay, so this is the net present value. Because it's a positive, we should invest in it. Okay, so now the second part of the question is saying, what's the the annual cost savings benefit has to be? So I will be indifferent to invest or not invest. This is the sensitivity analysis. Basically, it's saying what is this number has to be to make everything equal zero, net present value equals zero. So this is the annual cost saving. If you say what's the interest rate to make the whole thing equal zero, point of indifference, this is called IRR. If we change this, this is called IRR, to make the net present value equal zero. So point of indifference, interest rate. Okay, so I have investment. I don't know this amount, so basically this amount we don't know. Times this interest factor plus the final, this number will make the whole thing equal zero. Okay, so this is the point of indifference. In cost savings. Okay, so cost 44,500 plus X we don't know times 6.7101 plus 3242 equals 0. So what is this cost saving has to be? Okay, so 6.7101x equals 41,258. So x equals 6149. Remember chapter 3, we talked about margin of safety. What's your safety zone? If your target, if your estimate 6,500 is wrong, by how much you can fall till you are going to negative. So cost savings at 6,500 net present value equals 2358. You can have this number misestimated. You can make a mistake. Maybe did not reach your objective. 6149, your net present value equals 0. So how much room can you be off? You can be off $351. Not much room. You can be wrong. Okay? So this is called margin of safety, sensitivity analysis. So remember in chapter, in cost accounting, we keep talking about margin of safety for us to figure out. Okay? So now, what's the payback period? Okay, so earlier I was talking about IRR is the interest rate will make the whole thing equal 0. Okay? So I want you to pay attention here. When you have a residual value here, you want to find out the interest rate. Is it 8%, 10%, whatever percent? Yeah, I forgot to write this. 8%, 10 periods. When you have two places with this number, it will be very difficult to calculate IRR. You have to do something called trial and error. So if you use 8%, it's positive. Let's make it higher, 10%. If 10% still don't get it 0, you keep going up till you become negative. Then you go back because there are two components. Need the same interest percent, but you go to two different tables. It's very complicated. So when we don't have the residual terminal value here, become very easy to calculate. That's why I want to show you the next question, okay? Originally, I did not want to do that question, but then I realized I test you that question, so I have to take it up, okay? So let's look at the payback come back here. All right, payback period, investment, 44,500. Each year, 6,500. So 6.85 years. The cutoff, 4 years. We're going to reject it because it takes too long. Okay, what's accrual accounting rate of return? Accrual accounting rate of return, AARR. Okay, this is the only calculation we need to include depreciation, amortization. Okay, so we already figured out the depreciation. The difference is 1,600. Additional, the new machine, you need to subtract additional 1,600. Are we okay with this? The old only 4,000, new 5,600. So by investing in a new machine, you have to depreciate more, 1,600. Okay, but we're going to get 6,500. But depreciation incremental, we call it incremental depreciation expense. The old is 4,000, the new is 5,600, so additional 1,600. So this is 4,900. What's the investment? 44,500. So this is 11%. 11%, our required rate of return, 8%. We should go ahead, invest. Net present value, invest. AAR, invest. Payback period, no. Okay? So now, I will ask you, what's the accounting income? Accounting income for the first year, because this is year after year, 11%. So what's accounting income for the first year? Okay, so accounting income, you calculate income statement. You're going to have an additional incremental profit, cost savings. 6,500 positive. But you also have an incremental depreciation expense. Every single item, 1 mark or 2 marks for your final exam, okay? So make sure you practice. Okay, so incremental depreciation expense is right here. $1,600, because the old 4,000, new 5,600, so additional 1,600. This is accounting income. You subtract depreciation expense, normal. Okay, now the third one is the gain or loss on disposal. Okay, we're going to get 20,500. But what's the carrying value in your book? Okay, so the cost is 50,000. Accumulated depreciation, 4,000 a year times 2 years. So the carrying value is 42,000. So right there, 21,500 loss. So for the first year accounting income, I'll ask you this. Make sure you practice, okay? 3 numbers, 5 marks. So negative. How much is this? I think 16,600. Okay, so this is it. Now I'm going to show you how to calculate IRR. As I mentioned before, if you have a residual value, it will be very difficult to calculate. Okay, so the first question, very simple question. So I'll show you IRR. Okay, Emerald Hospital, a not-for-profit institution not subject to income taxes. They don't have to pay taxes. They're thinking to buy a machine, and this is a very simple question, okay? The machine costing $20,000, so you don't have an old machine to exchange, you don't have working capital. Okay, so you're going to invest $20,000 for this equipment, but then you're going to save $5,000 every year. For how many years? 10 years. Okay? Then there's no residual value. Minimum required rate of return, 14%. Okay? So that's very simple. Asking net present value, internal rate of return, payback period, accrual accounting income. Okay. All right. So net present value, number one, net initial investment. I don't have a trading value. I don't have a working capital account, not released or tied up. So the only thing I have is 20,000. Okay. Number two, present value of annual cost savings. Okay, they tell us $5,000. Present value interest factor, annuity, 14%, 10 periods. Okay, so I go over here, annuity, 14%, 10 periods. So I go over here, 14%, 5.2161. So annual benefit is 26,080. Present value of the terminal value. Okay, I don't have residual value. There's no old machine, new machine. I have no residual value. Now, what else? Do I have working capital? No working capital, no reversal working capital. So this is nothing. So only three things, very simple. Okay, so we added three together, 6,080. This is net present value. We should invest. Okay, now, so earlier, what we did was try to figure out what's the cost saving to make the whole thing equal zero. Now, we say, okay, 5,000, we know it, but what's the interest rate will make the whole thing equal zero? The interest rate, this one, is IRR. To make the whole thing equal zero. And because we don't have the terminal value, become very easy to calculate. Okay? So I'm going to show you. 20,000 plus 5,000 times, I don't know the interest rate. What's this interest rate has to be to make the whole thing equal zero? I don't know. So times present value interest factor, annuity, X% interest rate, 10 periods, plus residual value equals zero will give me zero. This is called interest rate to make the whole thing equal zero. This is IRR. Okay? So it's very easy to calculate. So you take 20,000 divided by 5,000. This is a 4. If it's a payback period, it's the same calculation for payback period, except payback period is 4 years. This is the interest factor. Interest factor. Not 4 years. This is whatever the factor. 5.2161, this is a 4. Okay? Without terminal value, it's very easy to calculate. Now, I have to find 4 to find my interest rate. Okay, so I keep going until I see 4. Okay, no 4, no 4. Okay, so here's some 4s. Ah, you got stuck. At 20%, the interest factor is not 4, it's 4.1925. Okay? At 25%, 3.5705. So I think 4 is between these two, but it's closer to 20% rather than 25%. Okay, so what we have to do is we have to do interpolation to figure out roughly what's the percentage is. Okay, so at 20%, the corresponding interest factor is 4.1925. At 25%, the corresponding interest factor is 3.5705. So how about 4? I think 4 is closer to 20% rather than 25%. But is it on the 10 percentage? 25, 35, 45, 50, or 60%? What's the percentage? This is 4. I think it's closer. Is this proportion out of the whole thing is 30%, 35%, 40%, 15%? What's the percentage? So what we want to do is we want to do the interpolation. This out of the whole thing. So you look at the distance out of the whole thing. So whatever I'm doing now will be in the exam. So you better understand how I calculate, okay? So I take the distance 4.1925 minus 4. So I get the distance above. 4.1925 minus 3.5705 is the whole distance. So now I figure out this is 0.1925 and this is 0.622, which means that roughly around 31%. So I was right, closer, just looking at the number, is closer to 20% rather than 25%. So roughly around 31%. But the whole gap is 5%. 5%, you take 31%. So 0.3095 times 5%. This is roughly around 1.55%. We start with 20%. You add 1.55%. You get around 21.55%. It's not absolutely accurate, but it's close enough. If we use the interest rate 21.55%, then the whole thing will become 0. So it's much greater than the required rate of return, which is 14%. Okay? So this is how we calculate. Payback period is the same calculation. Okay? This is a payback period too. Investment 20,000, 5,000 every year, so 4 years. Okay, so this is the IRR. I will ask you this. I will ask you the accounting income. Okay, everything I do here, I will ask you in the final exam. Okay, now I don't have time, so I have to go chapter 18. Chapter 18 is performance evaluation. Okay? So performance evaluation only 1 year. We don't worry about time value of money. Number 1. Number 2. Because we are using returns, profit. Okay? So what kind of profit do we use? Normally, we will take away the depreciation amortization. So ARR is the same as return on investment. So we include amortization, depreciation in calculation. Return on sales, return, accounting income. We have to take away depreciation. Okay? The other two, you haven't learned. So this is the focus because final exam of this residual income. Okay, so pay attention to this. So this is about performance evaluation. If you do well, you work hard for the company, you make the right investment decision like what we did here, you should get rewarded. But what we are rewarding manager, you don't want to create something called goal incongruence, which means that I'm only looking after my own benefit. Okay? Even though it's good, net present value is good, but if you're going to evaluate me based on accounting income, this is the loss. I wouldn't invest. This is not good for the company. This is called goal incongruence. Whatever you want to do for yourself should be aligned with the company's benefit. Both benefit from it. Okay? So I'm going to show you all these calculations. The first two, you know how to do it. Now, what return do I use? Remember, this is not for BO2, financial accounting, not external creditor, external potential shareholder, investor. This is for internal evaluation. So you may have two managers in the same company, but different countries, okay? If you're using the net income, here's a problem. What's the problem? One manager in the country with a high tax rate, you pay lots of taxes, you have a smaller net income. The other manager, maybe in Asia, the tax rate is small, look very good. So you don't want this to happen because tax is something the manager cannot control. The government says you have to pay this amount. So it won't be fair if we use the net income. So what do we do? Okay, let's go before tax income. But before tax income, now you say, if your division is a bigger division, you're going to invest lots of capital asset, you borrow money, you have a lot of interest expense, versus another division, they don't pay a lot, they don't have a big investment, they have a smaller investment, they don't pay lots of interest. Becomes not fair. Okay, because if you reward manager, do not have lots of capital expenditure, you do not pay lots of interest, then you get more benefit. But I invest, I have lots of interest to pay, payment to pay, doesn't look good on me. So sometimes we forget about interest. We want to encourage manager to do their best, so we move up again. So we call it EBIT, earning before interest and taxes. EBIT. Earnings before interest and taxes. So these are the things that if you operate, and this is a fair assessment for everybody. Okay, you can use this. But then the manager in the bigger division is going to say, hey, I have lots of capital investment. I have a huge depreciation and amortization. Once you subtract using the return, my accounting income looks smaller, even though we forget about the interest and taxes. We want to be fair. Okay, let's be fair. So what happened is sometimes we use the number, this is for internal evaluation. We use something called EBITDA. You heard about EBITDA? If you watch business news, you're going to hear EBITDA a lot. It's earnings before interest, taxes, depreciation, amortization. That's good, okay? We don't worry about depreciation, amortization, big organization, smaller unit, doesn't matter. Interest, okay, we don't worry about it. And taxes, we don't worry about it. So now everybody's fair. $100 of sales, what do you get? Okay, return on sales, return on investment. Now, what kind of investment we're talking about is asset or equity. And what kind of asset? Are we talking about some division, maybe open up the business 20 years ago? So the asset, everything they acquire much cheaper. Now you have another division, only opened 5 years ago, much more expensive. So you know if you take the return divided by asset, one asset will be smaller because older cost smaller, newer cost is higher. You divide it by bigger denominator, guess what? The return is going to be smaller. So what do? Do you have to adjust or not? Okay, so very quickly. Okay, so here. at the short term, 1 year. So we don't worry about time value of money. Okay, we don't worry about time value of money. So return on investment, return on sales. Very quickly, I'm going to come back to talk about residual income. Okay. So why do I put this one here? When I was writing my professional exam to be an accountant, okay, they asked us this in the final exam, management accounting. So if it is a not-for-profit organization that you work for, it won't be fair to evaluate everybody based on profitability because you are not profit organization. How can you have profitability? So you cannot use net income, okay? So we use something called 3 E's, 3 E's. Number 1 is called economy. So basically, if you're not for-profit organization, what's the least expensive, most economical resources you can get to serve, to do get a good deal, basically, okay? Efficiency, effectiveness, so 3 E's. A lot of students confuse it with efficiency and effectiveness. Effectiveness means achieving your objective. If you're very effective, you achieve whatever you want to achieve. You achieve your goal. Efficiency is about productivity. The government give you funding, $50,000. How many meals, hot meals that you serve to homeless people? Of course, the more, the better. So it's looking at relationship between input and output efficiency. If you're very efficient, limited resources, you can serve a lot of people. Okay, so this is the 3 E's. Now, you can look at this advantage, disadvantage. In general, somebody did the research. In the world, big company, what do they evaluate performance? The highest number, highest measure, okay, the company use is called return on investment. But what investment, what return do they use? Everybody use different amount number, okay? But that is the most popular approach. Doesn't matter, big division, smaller division, everybody can use return on investment. Okay, so income, net income, before tax income. What income do I use? Before tax, after tax. Remember, this is for internal use. Please do not email me, okay? Do not email me about what number to take. This is based on the company. The formula, how we calculate, is the same as financial accounting, but you have to consider this is for evaluation. You don't want to discourage management's effort. So you want to be fair. Okay, so investment, you use the total asset, the current value, or historical value. This is what we're talking about. Okay, so there are 2 more measures. Most likely, you don't know them. Okay, so it's called residual income approach. So both are called residual income approach. The calculation method is the same, but we take different number to calculate. Calculation is the same, but we take different number to calculate. Okay, so residual income is we take net, the regular one, net operating profit before tax. So you take the operating income before tax minus the cost of capital, is called required rate of return, times investment. So you use other people's money, there's a cost of using other people's money. So this is called cost of capital. You borrow money from somebody, you have to pay interest. Shareholder also have a demand in terms of how much they want to get. Okay, so using other people's money costs you money. Okay, so net operating profit before tax. Suppose the company has net operating profit before tax, $120,000. I'm just making up the number, okay? Required rate of return, let's say 8%. Investment is $1 million. So the cost of using other people's money is $80,000. Your profit before tax, $120,000. So you have $40,000 leftover profit. You add value to the company, you should get rewarded. The problem with this approach is it's absolute amount. So always in favor of a bigger division, because bigger division, bigger profit minus cost of capital is still bigger number. Okay, the other one is called economic value add. It's the same as residual income approach, how we do it, but the number we take is different. So it's called EVA, economic value add. If you add value, you should get rewarded. Okay, so how do I calculate this? Instead of using net operating profit before tax, first, because we live in the world, we have to pay taxes. So whatever the operating profit, usually we subtract interest, then we pay taxes. But here, listen, we reverse the order. Okay, so we pay tax first. Net operating profit after tax, no PAT. So whatever the operating profit you have, let's pay tax first. Because in income statement, we subtract interest expense. But what happens is, if you use shareholders' money, shareholder expect dividend. It's not calculated in income statement. So minus something called WACC, weighted average cost of capital, times investment. So basically, we figure out what is the profit after we pay tax first, and then we subtract cost of capital. So it's a little bit reversal of what we do in income statement. But income statement, we only calculate interest expense. We do not calculate dividend. So here is the money coming from shareholder, from creditor, we don't care, okay? If you use other people's money, this is called cost of capital. Okay, so first of all, this is before tax. We have to calculate after tax. So suppose that after tax, the tax is 25%. So 120,000, I'm just making up to demonstrate to you, times 1 minus the tax, 25%. So 75%. After you pay 25%, 75% is your profit. 90,000. Okay, now I'm going to tell you in the exam, if I give you this number, I want you to calculate residual income. Will you be able to convert backwards? Forward, backwards, will you be able to do it? If this is net income, okay, whatever the income, this is after tax, I want to figure out before tax, what do? Divided by 1 minus the tax. You bring back to that. Okay? Before tax, times 1 minus the 25%. Give you after tax. Okay, so how do I calculate WACC? Suppose the investment is still $1 million. Okay, so this is a new project. I'm going to invest $1 million, but I need to get money from different sources. The company does not have all the money for us to invest. So how do I raise this money? Okay, so first I say I'm going to go to the bank to borrow 400,000. Okay, so this is the weight. How much I'm going to borrow from the bank? Okay, so 400,000. Now I'm going to issue new shares because the company do not have enough money to invest invest $1 million from the savings. So I'm going to raise $500,000. Okay, the rest I'm going to get it from retained earnings, our own saving, $100,000. So altogether is $1 million. Where do I get the $1 million? Borrow from the bank, raise money from the shareholder, and existing shareholder own the business, we have retained earnings. Okay, so this is the weight is for us to calculate percentage. The WACC, the weight, percentage. So how do you calculate? You take 400,000 divided by 1 million, so this is 14%, 50%, 10%, altogether 100%. So you take each source out of $1 million, 400,000, 40% from the bank, 500,000, 50% coming from the new shares. Okay, so now this is the rate, or we call it cost of capital. How much is going to cost you? Suppose the bank say, I'm going to charge you right now, the going rate is 5%. Okay? The new shareholders say, I'm the one who take the highest risk. I demand more return. So my return, I want 12%. An existing shareholder, they require 10%. So everybody wants different amount of return for their money put in the company. You cannot take 5 plus 12 plus 10 divided by 3 evenly because they are not even weight. 40, 50, 10. So you cannot add them together divided by 3. You cannot do that. Okay, now another thing is, if we use debt, we have to pay interest. Interest is what we call tax deductible. Because the interest expense we subtract from income statement, you have a smaller taxable income. You pay less taxes. So having interest is good. But your dividend is paid after you pay taxes, 1 for 1, you don't have any benefit. So only the debt, we get the tax benefit. 1 minus the tax, 25%. Okay? This is all 1 and 1. So how do I calculate? I take 40% times 5% times 1 minus 0.25 after tax, the cost. Okay? So now, effective interest rate is not 5%, it's only 1.5% because we get a tax benefit. We don't pay so much tax because we subtract interest. Okay, next one is 0.06 and 0.01. Altogether is 0.085. So WACC, weighted average cost of capital, is 8.5%. Okay, so here, 8.5% times 1 million. So from different sources of money, on average, costs you $100, you have to pay $8.50. So this is 85,000, 90,000 minus this equals $5,000. Still positive. As long as it's positive, the manager should get rewarded. Okay? So this is what we call residual income, economic value add. These two methods always in favor of bigger division, because bigger division, you have a bigger profit. Okay? So now I'm going to do a question. Let me see if anything else. Okay, so talking about performance measure, you want to have a metrics, how to evaluate performance based on fair, equitable. Okay? So it's important in the management control system, it should be motivating people to do their best. You want to promote goal congruence. You want them to invest, do the best for the company. There's another term a management accounting term. Moral hazard means one person, they're so motivated to do something very recklessly, high risk, knowing that if something goes wrong, they are not personally responsible at the company's expense. So that's called moral hazard. They don't care. Sometimes, you know, those trader in the stock market, they're very, very risky. If something goes wrong, well, the company suffer the consequence, not themselves personally. Okay, so I'm going to do one question to show you. I think that's it for the theory part. Okay, we will talk about all this. Okay. Chapter 18. Oops. Okay, so the question I want to work with you is the additional question. This question has all kinds of stuff. So this is very similar to the final exam question because I have chapter 13, long-term investment decision and performance evaluation together. So you get a taste of what kind of question I will ask you. Okay, so NSC is considering purchasing a new computer network for $72,000. Okay, so this is a network. It will require additional working capital. So you have to pay more money for working capital, $8,000 in the beginning. It's anticipated 7-year life, so they're going to use this network for 7 years. Will generate additional client revenue of $31,000. Okay, read this question very careful. You're going to have a revenue of $31,000. What's the expenses? Expenses, operating cost, excluding amortization, is $14,000. A lot of students have difficulty reading this part, okay? So operating cost, this is English reading, okay? Off, you skip. Comma and comma, you skip, you jump. Operating cost is $14,000. This $14,000 excluding amortization. We don't worry about amortization. This is good for calculating net present value. If the $14,000, we already have a depreciation here. Let's say $2,000 included depreciation. Then you have to take away the depreciation. Only $12,000. So when we calculate net present value, do not include depreciation. So this one is good. $14,000 is all cash expenses. Okay, the straight line amortization will be used at the end of 7th year. We'll have salvage value of $9,000. So we can get $9,000 if you invest in this. And return of $8,000. So working capital return, which means that in the beginning you have to pay more. They are opposite. I'm telling you, okay, year after year, very smart student always make mistake. This part in the final exam. Okay, so income tax rate is 40%. Required rate of return 12%. What's the net present value? What's the point of indifference in terms of the incremental cash flow? This is the same question as what we did the previous one. Just look at the cash savings. Okay, what's the payback period? What's the accrual accounting rate of return? Okay, so these are the chapter 13 material. The other two parts. Assume NSC will raise 50%. So now you don't have to calculate what's the percentage. Earlier, here, I give you dollar amount is to calculate percentage. But this question already tell you 50%. So that's easy. 50% of proposed investment from First Canadian Bank, 6%, okay? 30% from retained earnings, so the company's savings, you can come up with 30%. And that costs you 12%. This is the rate, okay, cost. The rest of the funds, which is 20% left over, you raise money from new shareholder at 14%. So what is NSC's EVA? Assuming NSC for EVA for this investment, only for this investment, okay? Assuming NSC's net income, total asset, 60,000 for net income, total asset 320. Okay, so this is the whole overall company. The other one is for the investment. This one is for the whole company. So they want you to figure out what's the residual income before the investment and after the new investment. Okay, before and after. Okay, so let's do the question. Net present value. It's a simple question, not too long. Net present value. Number one, net initial investment. Cost 72,000. Do I have trade-in value? No. Working capital, positive or negative? Require more? Negative. If this is wrong, everything else is wrong. Okay? So your net initial investment is 80,000. Number two, present value of annual benefits. Okay? So if I invest in this network, revenue 31,000, but additional cost will be 14,000. So I make 17,000. Do not include depreciation. Times present value interest factor, annuity. Required rate of return 12%. Okay? How many years? 7 years. Okay? Last one. I can go and find out the factor, but I come back later. Okay? So present value of terminal value. Okay? I have 1 and 2. Incremental residual value. New minus the old. New, I'm going to get 9,000. Old, I don't have an old, so $9,000. 2, reversal of working capital. So working capital in the beginning, 8,000 negative, now coming back, positive, 8,000. It just happened, the end, I also get additional 17,000. One more time. It's not every year, okay? So present value interest factor, one lump sum, 12%, 7 period. Okay, are you okay with this? Net present value, how many times we did? Many times, right? So 1 to 3, you calculate the difference. Terminal value, there are only 2 components. Okay, so I'm going to go back here to figure it out. So this is 12%. Okay, how many years? 7 years. Perfect. So 7 years, you don't times 7, you times 4.5638. Okay, now you go to lump sum. Okay, so 12% and go to 7, 0.4523. So the benefit for 7 years, that is 77,585. Additional one portion of 17,000 one time is 76.93. I just run it up. So net present value equals 5278. Net present value. Okay? So this part of the question can be A next question is saying, what is point of indifference in terms of cash flow? So what is this number has to be to make me indifferent to invest or not? So if I ask you the interest, it's called IRR, interest rate. But this one is asking you how much saving we need to have. Okay, so point of indifference in cost savings or benefit. Okay, so $80,000 plus X, we don't know, but we know the interest factor is 4.5638 plus 7693 equal 0. It's the same practice what we did previous question. Okay? So now 4.5638 X equals 72,307. So X equals 15,843, somewhere around there. So this is the sensitivity analysis, marginal safety. When we have a benefit, cost savings at $17,000, net present value is this, 5278. You can be off your target, 15,843, your net present value becomes 0. So how much can you be off in your estimate? You can be off $1,157, not that much. And you're going to be just break even. Okay, so now payback period. How long does it take for me to get my money back? Payback period. Investment 80,000, every year 17,000, 4.7 years. Okay. If you need to take a picture, you can take a picture. Okay, so how about accrual accounting rate of return? This part you need to include depreciation in the calculation. Depreciation. Okay, so payback period. No, sorry. Accrual accounting rate of return, AARR. Okay. We're going to get additional $17,000. What's the depreciation expense? Investment, 80,000. Okay, so what's depreciation expense? You say investment, 80,000. Can I just take 80,000 to calculate depreciation? No, why not? Remember I told you about my sister's rental property. So she spent 28,000. Not all 28,000 you can depreciate, because some are labor. How can you depreciate labor? You cannot. Some are overhead. You cannot depreciate. So what you can depreciate is only the computer network. You cannot depreciate working capital. You cannot depreciate inventory. How can you depreciate inventory? How can you depreciate accounts receivable? You cannot. So the only thing you can depreciate is the computer network, 72,000. So be very careful. Not the cost you take it out to depreciate, is what's the asset you're going to depreciate. Okay? So 72,000 minus residual income, 9,000. So 63,000. How many years? 7 years, which means that each year I need to depreciate $9,000. So now you make 17,000, but you depreciate 9,000, so the leftover is $8,000 over 80,000. So this is 10%. Are we going to invest? Required rate of return 12%. Reject. No, we are going to invest. Okay, now finish the fourth. Now we're going to look at the EVA. Does this project add any value to the company? Economic value add. Okay, so we're going to figure it out. Net operating profit after tax minus WACC. Okay, so EVA calculation is net operating profit after tax minus WACC times investment. Okay, so net operating profit after tax. Operating profit, this is the operating profit. You have the additional revenue, you have additional expenses, you have additional depreciation expense. Okay, so here's 8. Okay, I'm going to write it down for you. Okay, 17,000 minus 9,000 equals 8,000. But after tax, so 8,000. 1 minus the tax. Tax is 40%. The question says 40% here. So 40% go to government. Bye-bye. Now 4,800. WACC, weighted average cost of capital. So the question gives us the calculation. Okay, number to calculate. The debt, 50%. This is the weight. Okay, the cost is 6%. After tax, 1 minus the tax. Okay. Now retained earnings, 30%. Need 12%. Too bad. No savings. No tax savings. 1 for 1. Okay, new shares, leftover 20%. This is 100%. Okay, they require 14%, so 1 for 1. So now we do the calculation. So effective interest rate for the debt is not 6%. Okay, it's 0.018, 1.8%. The other one, 0.036%, 0.028, 2.8%. Altogether, 0.082. This is WACC. So you don't take the 3 rate, divide it evenly, no. Depends on how much the weight of each source. So 8.2% times investment, $80,000 for this project. Okay? So this one is 65, I think 6560. Let me do the calculation. 6560 maybe? $65.60. So you calculate, you only this project after tax, you pay taxes, only give you 4,800. But the cost to use other people's money more than what you make. Why would you do this? You won't. So 1760 negative. You you're going to reject if you use the EVA to evaluate this project. So you can also use EVA to evaluate the project. But of course, it's not as good as net present value. So you don't want to use EVA to evaluate the performance of the manager. Okay, so the last one is company's net income. So this is the company as a whole. This one is only looking at one project. So before we invest, 60,000 is a total net income. 320,000 is the total asset. So we want to figure out residual income, RI. R calculations net operating profit before tax minus required rate of return times investment. Okay? All right. So we have to do it before and after. Before and after. Okay. So before the investment, just use this number. All right. So 60,000 is net income. I need before tax income. So this is what I'm saying. Will you be able to convert to before tax income? Yes or no? Okay? Divided by 1 minus the tax. So 60,000 is 60%. 100% is 100,000. Are we okay with this? You must be able to convert back. Okay, there's one question. Minus cost of capital. This is called cost of capital. How much it costs you to use other people's money. Required rate of return. Required rate of return, the company's at 12%. Investment is the total asset, 320,000. So 320,000 is 38,400, 61,600. This is the residual income before the new investment. Okay? All right. So after the investment, we add the investment. Of course, we add more profit. So now 60,000 divided by 1 minus the 4 is 100,000. This is the same as before. But our additional investment give us additional 8,000. This is before tax. After tax, 4,800. But EVA use after tax. But residual income used before tax. So we use this before tax. Plus $8,000. So 108,000. Minus required rate of return, also 12%. Okay, now your investment, 320,000. We add additional 80,000. Now the total company's asset become 400,000. The cost of capital on average, 12%. So this is $48,000. You use other people's money, 400,000. Okay, in general cost you 12%. 108 minus 48, the answer is 60,000. Oh, too bad. Without investment, if you're going to be evaluated based on residual income, you said without investment, I have more. With the investment, I have less. Why do I want to invest? This is called full incongruence. Because net present value is positive, we should invest. Okay? But here, you look, it's worse. EVA is worse. So why would anybody want to invest? Look back. No. Okay? So are we okay with this? Okay. I have 10 minutes, so I'm going to show you another question. Okay? And you should take a look at that question as well. I won't be able to do the whole question with you. Okay, so it's this question. Additional, this is an exam review question. Okay, final exam review question. So I'm just going to go over the important parts. I won't be able to show you the calculation because I only have 8 minutes left over. Okay. So the general manager of this company is facing, should I replace the existing machine or not? Okay, so this is the new quote for the new machine. The original cost of machine is 1.1 million. When we purchase it, we're going to use this for 11 years. When was this purchased? 6 years ago. That's why the current age already 6 years. How many years to go? 5 more years to go. Okay? Now, if you look at the new assembly equipment, it's going to cost you $1.2 million. How many years to go? It's a new, never been used, so 5 years to go. So it ends the same time. This is good. Okay, so accumulated amortization means being used up. How much? 600,000. How come it's 600,000? Because if we calculate depreciation expense, okay, $1.1 million. What's the residual value? They tell you terminal value, disposal price in 5 years, 0, 0. So both machine, not better off, not worse off, the same. No incremental. So minus 0. 11 years. Each year, $100,000 depreciation expense. This is not important if we're calculating net present value. Okay, this is the old machine. How about new machine? The new machine, $1.2 million. Residual value is 0, divided by 5 years. Each year will be 240,000. You depreciate more. Okay? Now, that's why the book value is 500,000. You pay 1.1 million, 100,000 6 times, 6 years, 600,000. So the carrying value, 500,000. Now, if I'm selling it today, I only get 200,000. So right away, you have a loss. If I ask you to calculate accounting income for the first year, I will ask you this, okay? Make sure you know how to answer this. Accounting income for the first year, you're going to have a loss because you get $200,000. But carrying value, 1.1 million. Each year, 100,000. Amortization, how many years? 6 years. 600,000. So your carrying value, 500,000. You're going to lose out 300,000. This is the loss. Very important. Okay, so now let's take a look at anything else. Average working capital needed. Using the existing machine, 120,000. If you get a new machine, you only need to spend 70,000. This is the adding back or spending more. You have to be able to read this. I'm going to ask you. Okay? Using the existing machine, you pay 120,000 for inventory. If you buy the new machine, you only have to pay 70,000 inventory. You have a saving or you have to spend more? You have saving. Important. You have to be able to read the question. Okay? Alright. So what else do we have to pay attention to? So I already show you the incremental depreciation expense. So this is to figure out accounting income. So you take the old minus the new. The reason I switched the two because depreciation is negative. So old is 100,000, new is 240,000. So you're going to spend $140,000, but you don't pay it. In the income statement, you subtract more. Okay, so now what happened with the other is the incremental operating income or cost savings. Cost savings, how much you can save. Okay, so you have to look at these numbers to figure out. So you see amortization, 100,000 right here, 100,000. Okay, so what did the question ask us to do? Net present value. Okay, should we invest the new, replace the existing machine? Okay, suppose the next year is the last year. This is the part I want you to focus. Okay. Suppose next year is the last year, they'll offer this attractive bonus plan, but based on what? Based on accounting income, short-term accrual accounting income. So accounting income is the first year. Accounting rate is year after year, every year is the same. Okay, the accounting income the first year, you have a loss right there. Well, Asafi be inclined to replace the machine or not. Okay, so right here, losing money, he's not going to. 300,000. Okay, so 2 minutes, let me see how much I can go, okay? So depreciation we already figured out. New equipment will produce more swiftly. Okay, that's fine. So working capital, you release it. Direct material, so the cost savings, annual cost savings. Direct material, $120,000 is waste. So new equipment will reduce this to 20,000. So I can save, reduce to 20,000. So I can save 100,000. For the material, I can save. Okay, new equipment is expected to reduce the direct labor by 150,000. You can reduce the labor by 150,000. So direct labor, 150,000. You save. Maintenance and repair has been excessive. If buy a new machine, now the repair cost decreased to 100,000. So what's the original repair cost? Repair, 150. Maintenance and repair, originally 150,000. Now can reduce to 100,000. So I save 50,000. Okay, Coronado collects all supervision, so I have a supervisor cost. It's based on, we put everything into the one cost pool, the costs are then allocated to each department based on labor. But assembly, so this assembly division only have one supervisor. The supervisor is not going to be laid off, so there's no supervision, no savings, because it's allocated. The base doesn't change, you don't have savings. Okay, so now we can reduce the space by 20%. So we allocate 8,000 to assembly line, but this place you can save, you have empty space, but you still have to pay. No savings. So the rent, oops, no savings. What else? Overhead allocated based on 30% of the labor. Even though the labor saved, the overall overhead did not shrink, no savings. Okay, so allocated, that's why we call it irrelevant. Overhead, 0. So altogether we save 300,000. So if I want to figure out accounting income, okay, incremental benefit, I'm going to get 300,000 40,000. This. But then I also have an incremental depreciation, 140,000. Then I also have a loss on disposal, 300,000. So altogether, 140,000 negative net loss for the first year. Okay? All right, so that's it for now. And the last class will be presentation. As I mentioned, I do not like you to leave. You all sit till the end, like me. But you have to print the 5 sheets for me, okay? Double-sided, so I can make remarks. All right, so I